Welcome. Today we'll walk through a practical example of corporate tax calculation using ABCSDN, BHD, for the year of assessment 2024. Understanding how to compute your company's tax is crucial for compliance and financial planning. We'll break down each step, from identifying income and expenses to applying capital allowances and finally calculating the tax payable. Whether you're a business owner, accountant, or student, this guide will help clarify the process. Let's start by looking at the company's financial summary and see how each figure plays a role in determining the final tax amount. First figure we need is the gross revenue. For ABC SDN, BHD, the gross revenue for YA 2024 is RM 500,000. Gross revenue represents the total income earned by the company before any expenses are deducted. This is the starting point for tax computation, as all subsequent calculations will be based on this amount. It's important to ensure that all sources of income are accurately reported to avoid issues during tax assessment. Now let's move on to the next step, identifying allowable and non-allowable expenses. Next, we look at allowable expenses, which are costs that can be deducted from gross revenue to reduce taxable income. For ABC SDN, BHD, allowable expenses include salaries and wages of RM 120,000, rent and utilities of RM 50,000, and EPF contributions of RM 15,000. These expenses are essential for running the business and are recognized by tax authorities as deductible. The total allowable expenses add up to RM 185,000. Deducting these from gross revenue helps lower the company's tax liability. Not all expenses can be deducted. Non-allowable expenses such as penalties and fines must be added back to the income. In this example, ABC SDN, BHD, incurred fines totaling RM 3,000. These are not deductible for tax purposes, so they increase the adjusted income. It's important to distinguish between allowable and non-allowable expenses to ensure accurate tax reporting and avoid underpayment of taxes. Now let's compute the adjusted income. Start with the gross revenue of RM 500,000, subtract the total allowable expenses of RM 185,000, and then add back the non-allowable expenses of RM 3,000. The calculation is 500,000 185,000 plus 3,000, which equals RM 318,000. This adjusted income forms the basis for further tax computation. It's a crucial step as any errors here will affect the final tax payable. Capital expenditure refers to money spent on acquiring or upgrading physical assets like machinery. For ABC SDN, BHD, RM 100,000 was spent on purchasing machinery. Unlike regular expenses, capital expenditure cannot be deducted directly from income. Instead, companies claim capital allowances over several years, spreading the deduction. This ensures that the tax benefit matches the asset's useful life. YA 2024 ABC SDN, BHD, claims a capital allowance of RM 20,000 on the machinery purchased. Capital allowance is a tax deduction spread over the asset's useful life, reducing taxable income each year. This year, the company can deduct RM 20,000 from its adjusted income. It's important to keep proper records of all capital assets and the allowances claimed to ensure compliance and maximize tax saving. After deducting the capital allowance, we arrive at the chargeable income. For ABC SDN, BHD, the calculation is RM 318,000 adjusted income minus RM 20,000 capital allowance, resulting in a chargeable income of RM 298,000. This is the amount on which corporate tax will be calculated. Chargeable income is a key figure in tax computation, as it directly determines the tax payable. Malaysia, SMEs enjoy a preferential corporate tax rate. For the first RM 600,000 of chargeable income, the rate is 17%. Any amount above that is taxed at 24%. However, in this example, ABC SDN, BHD's chargeable income is RM 298,000, which falls entirely within the 17% bracket. Understanding the applicable tax rates is essential for accurate tax planning and compliance. Compute the tax payable, multiply the chargeable income by the applicable tax rate. For ABC SDN, BHD, the chargeable income is RM 298,000 and the tax rate is 24%. The calculation is 298,000 times 24%, which equals RM 71,520. This is the total corporate tax the company needs to pay for YA 2024. Accurate calculation ensures the company meets its tax obligations and avoids penalties. It's important to distinguish between allowable and non-allowable expenses. Allowable expenses like salaries and rent reduce taxable income. Non-allowable expenses such as fines must be added back, increasing taxable income. This distinction ensures that only legitimate business costs are deducted, maintaining compliance with tax regulations. Proper classification of expenses is key to accurate tax reporting. Capital allowance is a special deduction for capital expenditure, such as machinery or equipment. Instead of deducting the full cost in one year, companies claim a portion each year over the asset's useful life. This spreads the tax benefit and aligns with the asset's depreciation. Keeping detailed records of capital assets and allowances claimed is essential for future tax filings. Tax rates differ for companies and individuals. Companies are taxed at a flat rate of 24%, with SMEs enjoying a lower rate of 17% for the first RM 600,000. Individuals, on the other hand, are taxed at progressive rates ranging from 0% to 30%. Understanding these differences is important for both business owners and employees, as it affects overall tax planning and compliance. Let's recap the key points. Allowable expenses reduce taxable income while non-allowable expenses increase it. Capital expenditure is not directly deductible. Instead, claim capital allowances over time. Tax rates for companies are flat, but SMEs benefit from a lower rate for the first RM 600,000. Individuals face progressive tax rates. Accurate classification and calculation are essential for compliance and optimal tax saving. Conclusion: understanding the steps in corporate tax calculation helps businesses stay compliant and optimize their tax position. Always keep detailed records, classify expenses correctly, and claim capital allowances where applicable. If in doubt, consult a tax professional to ensure accuracy. With these practices, your company can confidently navigate tax season and avoid unnecessary penalties.